Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
$51.59. That was the closing price yesterday, February 12th, 2026. We saw the stock open at $55.79 and then immediately retrace 8.15% in a single trading session. And this is happening just 24 hours after hitting a fresh 52-week high of 57.09. And the volume tells the real story here. Over 8.3 million shares traded on February 10th. That is significantly above the daily average, which usually floats between, 4.5 to 6 million? So the question we have to answer today is pretty simple. Is this 8% drop a classic, sell the news moment following a massive earnings beat? Or is the market signaling that it has fundamentally mispriced a company transitioning from a cyclical back-end provider to a critical piece of AI infrastructure?
I think the market is finally waking up to a very, very expensive reality. You look at that drop, and to me, that is not just profit-taking. No, it's a reaction to the bill coming due. We are looking at Amkor Technology, ticker AMKR. And look, while the earnings were impressive, the guidance suggests we are walking right off a cliff of capital expenditure that is going to absolutely strangle free cash flow for the next 18 to 24 months.
I see why you frame it as a cliff. It is a scary number, but I view it as the cost of entry for a structural renaissance. I mean, we are seeing a complete shift in how value is created in the semiconductor industry. It is moving away from front-end lithography, making the transistor smaller, and toward advanced packaging. My position is that Amkor is currently undervalued relative to the role it is about to play. I believe a five-fold return over the next decade is not only possible, it's mathematically feasible based on their historical performance and the current AI tailwinds.
And I'm sorry, but I just don't buy that valuation math yet. My position is that the risk here is being severely underpriced. You have a company proposing a Capex spend of $2.5 billion to $3 billion in 2026 alone. I mean, that is a staggering jump from the $905 million they spent in 2025. This is a bet the company moment. And with that lingering exposure to the smartphone market, the growth thesis is just much more fragile than the bulls want to admit.
Okay, let's dig into the thesis then. We are witnessing a structural inflection point. For decades, chips got faster by making transistors smaller. That is Moore's law. But that physics it's hitting a wall. It is getting exponentially harder and more expensive to shrink the die. So the industry has pivoted. The new way to scale is by packaging different chips together, memory, logic, everything, into a single unit. This is advanced packaging. Amkor is the orchestrator of this. And look at the immediate evidence. Q4 2025 profit came in at 69 cents per share. The street was expecting 44 cents. That is a 56.8% beat. That is not a company stumbling. That is a company executing.
Execution on the P&L is one thing. Execution on the balance sheet is another thing entirely. You're talking about the advanced packaging narrative, and I agree, the technology is fascinating, but let's look at the actual ledger. Management is guiding for up to $3 billion in capital expenditures. You cannot ignore that they only spent $905 million in 2025. We are talking about tripling the Capex in a single year.
To build the future, yes. You have to spend to build the capacity that NVIDIA and Apple are demanding.
But at what cost to the shareholder? Free cash flow was $308 million in 2025. With this level of spend, $3 billion going out the door, free cash flow will almost certainly turn negative for the next 2 years. They are going to be bleeding cash to build factories that won't yield revenue immediately. And the smart money sees this. Look at the institutional exits. D.E. Shaw sold 91% of their stake in the most recent filing. BlackRock sold 7.2%. Even a director recently sold about $5.75 million worth of shares. I mean, when the insiders and the quants are hitting the exit button after a price run-up, it tells you they think the stock is priced for perfection.
I think those sales are reactive to the short-term volatility, not the long-term value. Institutional funds rebalance all the time. But let's really get into the core of this disagreement, specifically this pivot to AI versus the legacy business. You mentioned the cash burn, but you have to look at what they are buying with that cash. They aren't just buying more wire bonders for cheap chips.
They are buying capacity, sure, but is the demand actually there to fill it immediately, or is it speculative?
Oh, it is concrete demand. Amkor is effectively becoming a regulator for AI hardware. Management disclosed they have 2 new high-density fan-out or HDFO programs that are in final qualification right now. These ramp into high-volume production in the second half of 2026.
Okay, let's pause for a second. For the listeners who aren't deep in semiconductor manufacturing, just clarify fan-out versus the old way. Why does this justify billions in spending?
Fair point. In the old days, you had a chip, and you used tiny gold wires to connect it to the board. That's wire bonding. It's cheap, reliable, but it's slow. Fan-out packaging allows you to take the connections from the chip and spread them out, fan them out, over a larger surface area, directly on the wafer. This allows for thousands of more connection points. More connections mean more data speed. This is essential technology for connecting AI processors with high bandwidth memory. If you don't have HDFO, you bottleneck the AI chip.
Okay, I'm not denying the technology is impressive. HDFO is the real deal. But my issue is the customer concentration and the competition.
But look at the market dynamics. TSMC is the king of this hill, right? They have their own packaging called CoWoS, chip on wafer on substrate. But their capacity is completely full. I mean, it is oversubscribed through 2026. Amkor is catching the spillover. They are picking up orders for NVIDIA's Rubin series and AMD's Instinct MI400 because TSMC literally cannot make them fast enough. Plus, the partnership with Intel to implement their EMIP packaging is a diversification masterstroke. It creates an alternative to the expensive silicon interposer. They are positioning themselves as the Switzerland of packaging, neutral, essential, and compatible with everyone.
That sounds fantastic in an investor presentation slide deck. The Switzerland of packaging. It's a great tagline. But let me give you a reality check on the actual revenue mix. You talk about AI like it's the whole business. It isn't. Communications, specifically smartphones, still accounted for 49% of Q4 2025 revenue. Nearly half the company is still tied to whether people decide to upgrade their iPhones.
It's a mix, certainly, but the mix is shifting.
It's a dangerous mix. That segment is highly seasonal and totally dependent on iOS cycles. If global handset replacements slow down even a little bit, that growth you're expecting from AI, the HDFO ramp, it barely covers the hole left by mobile. And let's look at the growth rate of advanced packaging in 2025. It grew 7% year over year. That is solid, I grant you, but it is not AI rocket ship speed. It's not 50% growth like we see with the GPU makers. You're asking investors to pay up for AI growth while holding a bag that is half filled with cyclical smartphone risk.
I see that risk differently. I view the smartphone business as the cash cow that funds the AI transition. You need that steady 49% revenue base to pay for the HDO expansion. And speaking of funding the transition, we have to talk about the Arizona project. This is the centerpiece of the bull case. The Peoria, Arizona facility is a game changer. We're talking about a $7 billion total investment plan.
$7 billion. That is a massive number. That's nearly the entire market cap of the company not too long ago.
It is, but it creates a domestic end-to-end supply chain. Apple and NVIDIA are demanding this to de-risk geographically. They want chips made at the TSMC Arizona fab to be packaged right down the street. They don't want to ship the wafer back to Taiwan for packaging and then back to the US. It's a logistics nightmare. And Amkor isn't footing this bill alone. They received a final award of $407 million in direct funding from the CHIPS Act, plus $200 million in loan authority, and a 25% investment tax credit. This significantly de-risks that Capex number you're so worried about.
It subsidizes the cost. It doesn't eliminate the execution risk. And this is where I struggle with the timeline. You're talking about a facility where Phase 1 completion isn't until mid-2027. Production doesn't launch until early 2028.
Infrastructure takes time. You can't build a clean room overnight.
Exactly. That is a long time. In the meantime, Amkor has to manage high U.S. construction costs, which are notoriously difficult. We've seen Intel struggle with this, we've seen TSMC struggle with this, and here is the kicker. Amkor's success in Peoria is tethered to TSMC's success in Arizona. If the TSMC fab faces delays, and let's be honest, fab delays are common, Amkor's facility sits there idle. It's a derivative bet. You are bleeding cash for 2 years, hoping that by 2028 the supply chain aligns perfectly. That is a long, long time to wait for a return on invested capital.
It is a long-term play, absolutely. But you're ignoring the efficiency gains happening right now that bridge that gap. This brings me to the margin expansion story. Management has a credible plan to expand gross margins by 100 basis points by exiting 2027.
100 basis points? That's 1%. It helps, but it's not exactly a transformation. It doesn't scream software margins.
It is a transformation when you look at how they are doing it. The Vietnam facility reached break-even in Q4 2025. They are moving the lower-margin SIP products from Korea to Vietnam. That is labor arbitrage 101. But the genius is that it frees up the high-tech facilities in Korea and Japan for the high-margin HDFO AI work. They are optimizing their geography.
Okay, strictly operationally, moving low-value work to low-cost regions makes sense.
It's asset optimization. They even had a $30 million benefit from asset sales in Japan in Q4. If they can move net margins from the current roughly 5.6% to 12%, which is driven by that mix shift toward AI, the earnings power of the company doubles. Even if revenue stays flat, which it won't, the stock becomes cheap. And if we look at the math for a 5x return, to turn this $51, $59 stock into roughly $258 in 10 years, Amkor needs a compound annual growth rate of 17.46%. Now consider this. Over the last decade, from 2016 to 2026, they achieved a CAGR of nearly 24%. And that was during a period with a global pandemic and mobile slumps. Requiring 17% when you have the AI wind at your back is actually a conservative target.
If, that is the biggest word in finance. Margin expansion is always planned but rarely guaranteed in a capital-intensive industry. Historically, Amkor trades at a discount to the semiconductor index for a reason. It is what we call an OSAT, outsourced semiconductor assembly and test. It is a factory business. It is heavy lifting. It is commoditized.
But the nature of the factory is changing. That is the point you are missing. OSAT is a dirty word for the old era. In the AI era, the packaging is the performance.
But the market hasn't priced it that way yet. To get your 5x return to hit that $258 price target, you need the market to re-rate Amkor to something like a 35 times PE ratio. You are asking the market to view a packaging company the same way it views a software design company like Synopsys or Cadence. That is a heavy psychological lift for investors. We are seeing Chinese competitors like JCET growing 19% year over year. The competitive landscape isn't empty. I just don't see the multiple expansion happening while cash flow is negative. Why would investors pay a premium multiple for a company burning cash?
Because the smart investors buy the Capex cycle before the revenue cycle. You buy the builder when they break ground, not when the building is finished. I think the multiple expansion comes from the realization that packaging is no longer a commodity. It is the bottleneck. If Amkor fails, the AI chips don't ship. That gives them pricing power they never had in the smartphone era.
Pricing power is theoretical until it shows up in the gross margin. Right now it hasn't. Let's wrap this up because I think we've identified the friction point. I acknowledge the technological leadership. HDFO is critical, and Amkor is a leader there. But I look at the Capex cliff of 2026 spending $3 billion when you only made $300 million in free cash flow the year before, and I see dead money. I think for the next 12 to 18 months, the stock drifts. The risk of negative free cash flow and the signal from insider selling suggest we could see prices significantly lower than $51.59 before the 2028 Arizona thesis actually plays out.
And I see the drop to $51.59 as the gift. The market is short-sighted. It sees the Capex bill and runs, missing the fact that Amkor is building the railroads for the AI economy. It is no longer just an OSAT, it is infrastructure. The 5x path requires patience, yes, but remember, the mathematical floor, that 17% KGR needed, is lower than their historical performance of 24%. The shift to advanced packaging isn't a trend, it is the only way Moore's Law continues. If you believe in AI, you have to believe in advanced packaging.
The question is, can you afford to hold it while they build the factory?
That is the question, isn't it? Does the advanced packaging renaissance justify the short-term burn?
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.